Welcome everyone to our Savvy Ladies Wednesday Wisdom webinar. My name is Maggie Montemuro and I'm the Marketing Coordinator at Savvy Ladies. If you have a question during the presentation, please type it into the chat box. And if you're joining us by phone, you can email your question to info@savvyladies.org. Today's presenter is Steph L. Wagner, divorce concierge and financial strategist for women. Steph is a thought leader on the subject of women in financial transition, and she assists women across the country in establishing a solid financial foundation. Steph is also a columnist for Entrepreneur Magazine and a contributor to Daily Worth and the Huffington Post. Thanks so much for your time today, Steph, and I'll hand it over to you.
Great. Thanks, Maggie. It is great to be here, and this is a topic that I'm very, very passionate about. And I'm hopeful that I can bring some good advice and support to the participants today. I think, obviously there's I don't know the exact place that you all are in your life, but I think it's safe to say that for those who are fresh out of divorce, you're likely emotionally and completely financially drained. And probably at times finding it hard to, if you're anything like I was out of my divorce, it was hard to put one foot in front of the other when all I really wanted to do was crawl back in bed. And I get it, I really do. And it's really why I absolutely love doing what I do. And, the reality is, statistically speaking, women come out of divorce in not so good shape. And finding the resources out there to help is really difficult. And that's what I love about Savvy Ladies and the mission that they're on, and really increasing the financial literacy of women. And it might not seem like it right now, but truth be told, this could be a tremendous opportunity for you. But you have to do the work, and it really starts by taking control back and owning your life, and your success really depends on the steps that you take. So today I really want to talk about 4 critical steps, and there's a lot of steps, but I know we have limited time, so I'm really trying to hone in on 4 critical steps that I see that's really important for women to take in order to own their life and to get their financial independence back. And first, we're going to talk about really creating a solid footing, and it's really kind of a housekeeping item, and you'll see as I get into it what I mean. And then the step 2 is really embracing your new life, accepting your new normal. What was is gone, and this is what it is. And you've got, the faster you accept that, the more positive action you can take. And then next, we're going to talk a little bit about establishing a plan and hopefully creating a plan that you can stick to. And I'll kind of give you some tricks of the trade. And then finally, I want to talk about just the importance of surrounding yourself with really the right team. So let's get started with, the first step, which is really executing your settlement. Establishing the financial logistics of your divorce is really only the first step, and you've got a lot of support to do that. If you did have an attorney help you, obviously you felt like you had a legal advocate, and hopefully you had somebody to help guide you through the financial aspect as well. But then you're kind of the Lone Ranger, and it's really your responsibility to see that the terms of your settlement are actually executed. And what I mean by that is really, I'm going to lay out about 4 of them, but there's a lot of things that you need to do. These are just the first 4 that I see all the time that not everybody does. The first one is really ensuring that all of the awarded financial accounts are now titled properly. You've got to actually see that through. Just because the decree says it, that's a roadmap, but now you have to really take steps to make sure that's all done properly. And I've listed here just a few, but there could be many more. And this may, you may only have a few of these, but I would like to bring up for those that, I like to give examples of pitfalls that I see. Some of these are fairly straightforward and just really require a phone call or an email to make sure things are done right, or a simple form. But one in particular that is not so easy that I just thought I'd touch on is 529 plans. In most cases, my experience has been lawyers and divorce decrees state something that legally makes sense, but it can't be executed the way they've roadmapped it in your divorce decree. And so hopefully that's not the case. But if it is, it's really important that you take immediate action and identify the limitations. For example, in my situation, we had 3 529 accounts for our children. They were each to remain the beneficiaries, and we were supposed to be the co-trustees. Well, 529s do not allow co-trustees. And unfortunately, my divorce was not a very amicable one, and I really feared that he was not going to use those accounts properly and that he might actually liquidate them, pay a penalty and tax, but use some of that money for his own needs. So unfortunately, it took about a year and quite a bit of money. In fact, I had to hire an attorney and go back to court, or threaten to get him to do what needed to be done. So I just bring that up because there may be others depending on your situation, but you don't want to delay because the cost, could be really damaging. Next, let's talk about, really confirming that all of the awarded assets are now not just titled, but transferred and divided the right way into the accounts that you want. There should be, again, instructions in the decree, but once again, you've got to actually execute that. And that's fairly simple, but it's just very important that you make sure that's done. These get a little bit trickier here. If you've got joint real estate, you need to make sure, depending on who was awarded that property, that a quitclaim deed is executed. And you need to do that right out of the gate while you still have a little bit of leverage to make sure that that's all done properly by either yourself or your ex. Same is true for personal property like cars, boats, anything like that. You need to title transfer. And I'll touch base a little bit more on these from a liability standpoint and things to watch out for later on. But just in terms of the name on these assets, you want to make sure you've done that properly, because the quitclaim deeds are filed with the county. And when you go to sell your property, you can't negotiate any contract if two names are on it, if you don't have both of you signing, the contracts to sell your property. So, likely you don't want to be negotiating a deal to sell a house, or, with an ex. It's got its own challenges. Finally, this is really important from a cash flow standpoint. Be sure you update your W-4 with your employer. Your status has changed. Your deductions have changed. Your filing status has changed. You've definitely you're in transition, and there are material changes. So these changes can likely impact your paycheck, and hopefully increase the amount of money you're depositing each month, and reduce the amount of taxes you're paying to Uncle Sam. A couple of warnings here that I see, and almost on a daily basis with the clients I help, is that only one of you can claim a child as a dependent. And the IRS is really gotten very good at cross-referencing both parents. And in fact, it's now form, where they're asking who that person is and their social security, etc. So make sure you do that properly, and you seek a professional as you're filling out and you're preparing taxes for the first time. Two parents cannot claim one child as a dependent. Again, with respect to filing status, few people realize the benefit that head of household status can have. So you want to be sure you do your research and select your filing status properly. And then once again, I mentioned this, quitclaim deeds do not remove you from a mortgage. And again, we'll talk about that in a little bit. Same is true with the car, but it can be a huge, huge problem for you down the line. So watch out for that. Now, next, I want to talk about the importance of disinheriting your ex. I see this so many times in what men and women forget to do. They think they're done, and they're really not. Now they really need to go in and prepare new documents, new wills, trusts if necessary, medical directors and power of attorneys. If you have a little bit of a contentious situation, I know for me it was a little creepy to think that my ex had the ability to pull the plug. God forbid something happened to me, and it's real important that you take that proper step. One thing I want to highlight, and again, I just really want to share with you some of the pitfalls I see so that you don't get hung up in those traps. Beneficiary designations on all retirement accounts like IRAs, as well as insurance policies, they trump your will and they trump your settlement agreement. So just because you've got both of those documents in hand with the proper changes, you've got to make sure that you work with your financial institution to fill out the proper forms to change the beneficiary. Now, this again is all part of step one. And like I said, we're kind of doing some housekeeping here. And keeping your close eye on your credit right out of divorce is essential. I cannot stress enough the importance to run your credit report. Even if you did this during the divorce process, please do it again. Not only do you want to make certain that there are no surprises on there, but it's going to help you figure out what liabilities are still out there that you need to remove your ex's name or you need to remove your name from. And be really vigilant about this. Don't assume that your ex is doing this for you. And I'm not suggesting that there's malice or anything involved. He's just busy doing his own cleanup and establishing a strong foundation. So you've got to make sure that you handle things from your end. I'm a big storyteller, and I went through divorce, and I'm really committed to using what happened in a positive way. And I just want to share with you something that caught me off guard, and why I'm so vocal about this particular item. I immediately out of the divorce, I sold my house, and I downsized into a condo. And when I went to apply for a mortgage, I got a very disturbing call from my lender, who basically was like, "What happened to your credit?" And I've always been a financial guru. I mean, it's just been my passion for, gosh, nearly, over 2 decades. And there's nothing that causes more anxiety to someone who is like obsessed with finance than to say that something's, your credit rating has been compromised. What I didn't know was that my ex-husband had actually forged a bank document and had opened a line of credit with my name on it. Obviously, then it's now part of my credit report. And he took out $35,000, which I was completely unaware of. And unfortunately, there was one delay payment. So my credit dropped 100 points, and I was at great risk of not qualifying for a loan. And fortunately, we were able to work this out very quickly and get this corrected. But again, I would have never known it had a credit report not been pulled. So it's really, really important. Now, I also just want to let you know that it's very, very common out of divorce that you need to rebuild your credit. It's either been harmed because financially things have been very complicated during the divorce process, or you just simply haven't had enough credit since you've been married for so long. So it's really critical that if needed, you take the proper steps to build up your credit and to secure a solid FICO score. And there's a lot of resources out there. You can go to myfico.com to learn more about this and the steps you need to take. I am personally an all cash. I'm not a fan of debt unless it's used strategically. However, it's really, regardless of your how much debt you have or your philosophy on it, it's really important to have those options out there and to have good credit. And then I mentioned this before, and I'll just bring it up one more time. Make sure your mortgage is going to sit, even if you don't live in the house and you've quit claimed it over to your husband, even if you're not making payments, the liability is sitting on your credit and on your balance sheet until he refinances. And that's something that not everybody realizes in divorce, is that these liabilities, again, you can transfer ownership, but those liabilities stay with you until those assets are refinanced. And that includes most often a car loan. And it goes both ways. Not a lot of women really want the house, and I understand that. But many times they don't realize they, at some point in the near future, are going to be forced to refinance it, and they have to qualify for that loan on their own, and that can be challenging. So watch out for that. That is certainly a pitfall, and I see it all the time. Next, ladies, it's like I mentioned in the beginning, it's the reality of your life. It's changed, and that you now have a new normal. And there are some really sobering facts on the aftermath of divorce, and the impact that it has on your finances. In fact, both men and women say, 58% of them say that they really essentially have nothing when it comes to their personal net worth coming out of divorce and after they pay for legal fees, etc. And the reality is, it's your pre-divorce lifestyle is going to obviously cost you a lot more. I mean, you've got two household or one household now being split into two. And it's really particularly hard on women. I mean, typically speaking, your standard of living has decreased or will decrease by at least 30%. So the quicker you embrace this new normal, and the sooner that you will be able to put things into action and really design a life that you can afford to love. And I can't stress this enough. We all kind of get stuck in the old way of doing things, and we're kind of conditioned, our bodies, after 20 years or 15 years, 10 years of doing something, that it's the right way. And let this be a time to kind of examine things and come up with a new way of doing things that are more empowering. And so don't get stuck in that rut of, well, I've always done it this way, I've always had my insurance here, these premiums are great, I'm going to stick with it. This is an opportunity for you to really go and explore some options that might make your life a little bit more efficient. Now, with this, I can't stress enough. I mean, the reality is you're in transition. And it's very, very important during this time that you embrace this idea of not just living within your means, but living below your means. Financially, it's essential, and emotionally, it's very, very liberating. You and again, it varies from people to people, but it's very often that savings is drained and you're starting over again, and you need to establish an emergency fund. And I typically recommend 3 to 6 months of living expenses. And I realize that might sound like a Herculean task right now, but if you start to embrace the idea of living below your means, this can happen quicker than you think. Another is that you really, by living below your means, you're freeing up some capital or cash to make contributions to retirement accounts, a non-negotiable expense. And we'll talk a little bit about that in a couple subsequent slides here in a few minutes. But again, when things are so tight, you have no freedom to release that anxiety over finances out of you, and you've got enough to worry about. So you want to work to remove as much stress as possible. Another thing I mentioned here is a future fund, and I talk about future funds a lot with women in transition. Again, this can be an incredibly exciting time for you, an opportunity to explore, businesses or opportunities that you might not otherwise have had, and you might need some money to invest in yourself, whether it's going back to school or starting a small business or whatever it is. So I like to create what I call a future fund, and to be able to set even a couple $100s a month aside, if possible, to let that build and then do something really productive with it to increase your self-worth, and your net worth. And again, it's very rare that anyone gets out of divorce without debt. So, living below your means clearly gives you some resources to tackle this quicker. Now, the next thing, I think a lot of moms out there are going to relate to this coming out of divorce. Your new normal may force you to really learn the power of the word yes, and to really learn to start saying no. And trust me, I fell into this trap. All of my yeses during the first year of divorce turned into one huge credit card balance. And I have 3 young boys, and I was so worried about their well-being that, and I have no regrets. We had wonderful memories, but they came at a cost. And the cost was much more than, the 15% interest being charged on my credit card. The cost, what I like to really talk about here when I get into, thinking about what no really means, saying yes to something always means you're saying no to something else. I mean, you can't have it all and ever. And neither can your kids, for that matter. And if you start to embrace this economic concept, and I realize, I'm going to really kind of just break it down and give you the everyday definition of how this is in one's life, but it's really opportunity cost is the value of your future value and your present value of what you give up when you actually say yes to something. I kind of look at it as you've got a path. I can go one way or I can go the other. Well, there's always an opportunity cost of picking one over the other. And one example that I use a lot in my work to kind of illustrate this, it's simple, but it's just a basic example of what you could do. If you go into Starbucks every day or another coffee house and you buy, a $4 coffee or whatever it is, not only are you using precious time, but you're obviously using precious resources. And those may not seem like a lot, but they add up. And when you start to think about what that choice of doing that every day for like 15 years, what that choice is costing you, it's sobering when you look at these numbers, but believe it or not, it's 1,000 hours over a 15-year period and close to $50,000 that could be used in your retirement account. And you get to that 50,000 by assuming that you would take every month that 130 some dollars and you would put it in your retirement account. And that, because of the beautiful thing called compounding, when you're investing in assuming it's going into the S&P, well, I'll just use that for an example, which historically has had a return of about 7% a year annually over the past 40 years. That amount accumulates to almost it's $48,000, but almost $50,000. That's an awful lot of money to work with, when you're getting ready to retire. So the whole idea of learning to say no starts to teach you that there's a cost to no versus a yes. Now, when I want to talk about establishing a plan, this is really my goal here is to illustrate something that gives you a framework that works for you and helps you kind of stick to it far beyond just what a budget would do. So let's kind of start talking about establishing a game plan. And I like to look at it a little bit differently than most. Typically, when I'm working with clients to create budgets, we immediately put our spending in 3 categories. We look at things as the unavoidables, and these are every month those fixed costs like rent or mortgage payments, car payments, insurance premiums, things like that. You really can't control them. I mean, you can move and reduce them, obviously, or go and start finding more less expensive premiums. But at the end of the day, they're pretty much fixed every month. Then we get into our not so avoidables. And these are for needs, everyday needs like gas and groceries, childcare. I mean, we can't avoid them, but we certainly can control through our day-to-day life how much we put towards them. And then lastly, the third category are those ending wants. They're the avoidables in our lives. There's things that we certainly can avoid. Obviously food is not an avoidable expense, but junk food is. And, every time you put those things in your basket, and they add up, and they also really sabotage the hard work that you're doing right now to rebuild your net worth. So let's break this down even further, and looking at those numbers as a starting point. But then to really establish a plan, you've got to look at things relatively speaking. And it's important that you take those total numbers that you're spending and let's look at what they are relative to your income. And right now I want to kind of talk through some parameters that will help you figure out if you're on track or if you need to make some adjustments right now in your life. I like to say that in a perfect world, and again, it varies where you live in the country, because, places like New York or, San Francisco, LA, the cost of living is so expensive that you might need to, change these up just a bit, but by taking from somewhere else. But in a perfect world, 45% or less of your income should be used towards your unavoidables. 30% to put a roof over your head, 5% for the boring stuff like utilities, 5% to get place to place like transportation or commuting, and then 5% for insurance and all those just in case costs. So what do you do with the other 55? Well, 20%, as I mentioned before, I just didn't have a percentage on it, is for your future. It needs to be an unavoidable expense. It's again for debt reduction, saving towards that emergency fund, and maybe contributing on a regular basis to retirement accounts. Again, it's an unavoidable expense, and I'll talk in a few minutes about ways that you can uh, can ensure that becomes consistent and it's not tempting to stray away from that. Now, lastly, the remaining 35%, I look at that as your empowerment money. It's money that you can take charge of. It consists of wants and needs, but it's things that you can do in your day-to-day life that you have control of. And your money needs to stop controlling you, and you've got to be successful, you've got to start controlling it. So again, I remind you of that opportunity cost example. And the choices you make have really big economic impacts. I just here stated an example like gas. I mean, that's clearly a need. You need it to go to work, to pick up kids, all of that. But you do have choices about how often you fill up. And there may, in fact, be some things you can do to be more efficient with that. Now, it's really important that you create a budget that works. And using the 45 20 35 model is really the first start here. And then you've got to learn how to implement it, things that you can implement to help you succeed. To make that 20% a non-negotiable expense, I would recommend trying contributing to savings accounts before you pay a bill, your bills in the beginning of the month. Make that be one of the first things you do every single month that you get paid, is pay yourself first. And you can do that by setting up automatic deposits into accounts, even retirement accounts. You know, and just a couple $100s will make a tremendous amount of difference 15 to 25 years from now. So don't get discouraged if the amounts are small. It's all about being consistent and not being tempted to skip a month. Set an amount, be consistent, and really stick to that. What I do typically for that empowerment money is I set up an allowance. I really try to stick to an all cash policy. And when it's gone, it's gone. Saving receipts and all that, it can be very, very, it's just oftentimes a pitfall to fail because, it's hard to constantly do that and total it up. Most of us, I mean, I get lazy. So I try to create an allowance and then stick to cash so that I don't, when it's gone, it's gone. And I have to make, obviously adjustments in my week. And then this is one of my favorite. I embrace the 7-day rule. If I really see something that I'm tempted to buy, I do everything in my power to kind of say, let me get it out of my mind and let's wait 7 days. And if I'm still stuck on it, obviously it might be something that's worth, going back to, but it definitely removes those impulsive purchases, which can sabotage us all the time. And then I just remind you here to come back to that word or that economic term I love, which is opportunity cost. And then obviously here, remember, this is only temporary. I mean, when you start to I'm not saying that you can jump off, a budget, anytime soon. And actually, I love it now and I've been doing it forever. It's just part of my everyday life. But some of these sacrifices you make that really seem difficult, they are temporary. And here, when you're establishing a plan, this really pertains to divorce in particular here. Be strategic. It's very common fresh out of divorce that you may need to buy a big ticket item. I mean, mattresses, furniture, just depends on your situation. Or on the other side, you might need to downside into a less expensive house. I mean, and I shared with you my story. If you need a loan, be strategic about the timing. The approval process might actually be easier right out of divorce. It just depends on the lender and it depends on your situation. You likely have a few years of some solid tax returns behind you when you guys were married, joint. Obviously, your situation has changed and you'll need to submit your divorce decree. But depending on the situation, you might be more successful if you explore that option right out of the gate. Now, it's very uncommon that we need cash. We need a liquid asset to go and purchase, a lot of these things to set up our homes. And oftentimes we may even need to buy a car or anything like that. Just be careful Don't rush out to liquidate retirement accounts. If that's your only asset, you've got to think of a different way. The penalties are too steep. 10% on early withdrawals, and then you're taxed by the IRS. So it can be, a 35% reduction on your asset at right immediately. And don't, no matter what, do not take cash advances off of credit cards. I mean, the average interest rate right now is 15.88%. And it's just becomes almost impossible to pay that down. But one great source is consider securing a home equity line of credit just to have in case of an emergency or to access that. I mean, the average interest rate right now, and I know we're expecting rates to go up here in September, it's 4.75%. A lot cheaper source of capital than a credit card. And finally, I just want to touch on this last step. I'm trying to squeeze a lot into this here, and I won't spend too much time on this, but I don't want, well, I do want to stress that your life really deserves a strong footing. And I find that in most cases, people think, oh, I don't have enough money to need a CPA or a financial advisor, or I don't need a will, I don't even need a trust, nothing like that. Make sure of that. Please talk to a professional. The reality is most of the time the relationships you had with these professionals in your divorce were your husband's relationships, and you now need to go out and find your team. But find people that are going to be committed to working together. Hire professionals that really are committed to working strategically with all of your advisors, because I look at a wheel and you're kind of in the center, and each of these team members, the CPA and the financial advisor and the estate planning attorneys, and maybe a life coach or a financial coach, or they're all part of the spokes, and for you need all of them working together to make that wheel move. Just yesterday, I'm just going to give you a quick example and end on this. I was talking to a woman that is fresh out of divorce, and she had taken over a property with her husband. They decided to wait to sell it, and they were finally going to sell it. The market had improved. It's been several years since the divorce was final, and simultaneously, she was actually buying a small condo. She thought they were completely different transactions, and so she handled them completely independent of one another. She sold the house. She got a small amount of proceeds, but still significant, and she put it in her bank account. And then in the same month, like I said, the timing just happened to be coincidental. She took the money out of her bank account, or some of it, and bought a house. Because that money hit her bank account and she did not get the advice of a CPA, she has a taxable event. She could have worked through this with a professional to make it seamless, where the money would have never hit her account, and it would have been a 1099 exchange, and it would have been a non-taxable event. And now, as a result of just not having those conversations, she's faced with a tax liability. So, again, I just bring that up because it's a real world example of the importance of really seeking good professionals out there. And I just want to really wrap up by saying, I'm trying to squeeze a lot of information into a very short period of time. So I obviously have missed a lot of things that might be important to you. So I really, if you have any questions at all, or there's anything that I haven't covered, or you want additional information or clarity on something I have covered, please don't hesitate to reach out to me. I mean, helping women emotionally and financially thrive out of divorce is really not only my work, but it's my passion. And giving back is just a tremendously huge part of my own healing. So don't be shy, and please email me at info@stephlwagner.com. And thanks so much. I really appreciate your time today. And I guess right now I will see if there's any questions.
Yep. Thanks, Steph. That was excellent and so helpful. And we did have some questions that came in, so we'll move along to those. The first question is, I was told that if I ever received an inheritance from my father, that I cannot put it in our current bank account if I'm thinking about divorce. But isn't that my asset?
Okay, yes, it depends. The answer to that question depends on the state that you live in. And, different states have different rules when it comes to separate property, community property, a marital asset, a non-marital asset. So it really depends on the state that you live in, and you're going to want to talk to again, part of your team, an estate planning attorney, to make sure that you've properly, taken all the proper steps there. If you put it in, if it's deemed a separate property, for example, you happen to live in a community property state and you put it in your own a joint account, you've got protection from whatever has been stated in your estate, your trust documents. So I would, it's a great question, and one that is somewhat complicated. So I'd be happy, this is a great example. You can email me and give me a little bit more clarity on your situation in terms of where you are, and I can better answer that.
Okay, thanks. And this next question is talking about a team. Do you have any suggestions if someone cannot afford to hire someone to help?
Yes, I can. There are some great resources out there where professionals, professional providers, or whether they're CPAs or Savi Ladies is a great one, for example, where this is obviously stemmed from Stacy's financial advisory firm, and there are some other great resources out there where professionals are donating their time. And I would really invite you to look for some of those nonprofits, because I think that's a great place to start. And you can likely get in touch with professionals directly, and they will donate their time to you and ask some specific questions about accounting or estate planning. Another one, I know for legal, I would recommend, there's some tremendously phenomenal legal websites. Novo is one of them that has, or Nolo, I'm so sorry, that has free, you can go and search some of these topics and get answers. And if you want to email me again and tell me the ones that you are specifically referring to, I'll send you links to those resources.
Mm-hmm. Okay, great. Another question is, I thought that my ex-spouse would be responsible for my legal fees because he makes more money than I do. Is that true?
I hate to say this, but it really depends on your state. And this is something that just drives me crazy. I'm on a mission to change the landscape of divorce in this country, and it shouldn't, to be honest with you, depend on what state you happen to get divorced in. I feel like there needs to be more of a standard law here so that we're all on the same playing field. So I say that, but the reality is it does depend. Oftentimes, yes, the outed spouse, which in your case is what you're referring to, you being the non-primary breadwinner, their legal fees and divorce fees, not just legal fees, but also financial fees, if they're seeking financial experts to help with their divorce, they will be covered, at least in part, by the primary breadwinner. And that's something that needs to be addressed during the negotiations and during the divorce process. It again depends on what state you're in, but you can actually incorporate that into your filing, into when you go and file for divorce, that you're requesting all of your fees, and so the judge would actually rule on that.
Okay. And Steph, can you just talk about how women can claim Social Security benefits of their ex-spouse?
Yeah, and that's great. I'm glad you brought that up. When you start thinking about your long-term financial planning and for retirement after divorce, Social Security is a big component for many. Few women realize that it's just standard. You don't have to do anything in your divorce process. That if you've been married more than 10 years, you can claim 50% of your ex-husband's Social Security benefits. And that, like I said, just happens out of the gate. He doesn't have to do anything. The only thing he really does need to do, so I take that back, is you cannot receive it until he actually files for Social Security. Now, one loophole around this is if you are in an amicable situation with your ex-husband, you can share this with him, and he can file and then suspend. And doing that will free up those rights for you. Now remember, the caveat here is that you're married 10 years or more and that you don't remarry. And also, you're receiving 50% of his, depending on what your Social Security benefits are. You're not going to take both. You're going to take the higher of the two. So there are some details in there that are worth exploring. But yes, most women, I know I didn't when I came out of it. I didn't realize that. Wow, that's that just happens. I just file something with Social Security, and that's something that obviously needs to be factored into your overall retirement planning.
Okay. Well, thanks again so much, Steph, for a great presentation. And thanks to everyone who joined us. We hope you'll join us again. Thank you so much for your time today, Steph.
Oh, you're so welcome. Thank you so much for having me and out there.
Thanks.
All right. Take care, guys. Have a great day.